Hey everyone, welcome back to Corporate Decoder, the place where we decode the mysteries hidden within corporate filings. This time, we're diving into Roper Technologies' latest financial report. You know, the one that shows how they've been doing through the first 9 months of 2025. Did they hit it out of the park, or are there some bumps in the road? Let's find out, but first, if you like getting the real story behind these financial documents without all the jargon, hit that subscribe button and join our Discord community, linked in the description below. We break down the important stuff so you don't have to. Alright, let's get straight to the numbers. Roper Technologies Incorporated is a company that operates in a few different areas. They've got their application software segment, network software, and technology-enabled products. Today we're looking at their performance up to the 30th of September 2025. First up, the top line net revenues. For the first 9 months of 2025, Roper raked in $5,843.9 million. That's a solid increase from $5,162.1 million in the same period of 2024. That's a jump of over 13%. Now, you might be thinking that is just good business, but let's see what's driving it. About 7.3% of that growth came from acquisitions, meaning they bought other companies, and the rest, around 5.8%, is considered organic growth, meaning their existing businesses are growing on their own. Their application software segment is the biggest contributor, bringing in $3,324.1 million in revenue for the first 9 months. That's up significantly from last year, boosted by recent acquisitions like Transact, Central Reach, and Procare. Their organic growth here was about 6.1%, showing that their core software businesses serving healthcare, insurance, and legal markets are doing well. The profit margin for this segment, called operating margin, was 26.9%, a slight improvement from last year. Next, the network software segment brought in $1,174.7 million. This is up about 6.6% from last year, with a significant chunk coming from the Subsplash acquisition. Organic growth here was a bit slower at 3.8%, mainly because their media and entertainment software business is facing some headwinds. However, the profit margin for this segment is impressive, sitting at a high 43.8%. Finally, the technology-enabled product segment had revenues of $1,345.1 million, growing 7.7%. Organic growth was solid at 7.1%, driven by their medical products like precision measurement tools and their water meter technology. This segment's operating margin was 34.8%. Now, when a company grows through acquisitions, we often see a big increase in something called goodwill. This is basically the premium paid over the fair value of acquired net assets. For Roper, their total goodwill jumped from $19,312.9 million at the end of 2024 to a whopping $21,336.7 million by the 30th of September 2025. That's about a 10% increase, largely due to those new acquisitions like Central Reach and Subsplash. It shows they are really investing in buying growth. Along with goodwill, they also have other intangible assets. These include things like customer relationships and technology. The net value of these intangibles grew from $9,059.6 million to $9,966.5 million. Amortization, which is like expensing these intangibles over time, was $607.1 million for the first 9 months of 2025. That is a pretty substantial number, reflecting the value of all those acquired customer lists and technologies. Looking at their balance sheet, total assets for Roper ballooned to $34,584.4 million by the 30th of September 2025, up from $31,334.7 million at the end of 2024. This massive growth is, of course, driven by those strategic acquisitions. A big chunk of this, over $31 billion, is goodwill and other intangible assets. That is a very asset-light business in terms of physical stuff, but heavy on intellectual property and customer relationships acquired through purchases. Now, to fund all these acquisitions, you often need to borrow money. Roper's long-term debt, after subtracting the short-term portion, ended up at $9,154.1 million. That is up from $6,579.9 million at the end of 2024. They also took on new notes in August 2025, adding to their debt load. This increase in debt is a direct consequence of their aggressive acquisition strategy, but it's not all borrowing. Roper generated a healthy $1,802.3 million in cash from its operations during the first 9 months of 2025. This is up from $1,671.0 million last year. That's a good sign, showing their underlying businesses are creating cash even as they integrate new companies. A nice boost came from a tax benefit related to research and development expenses, thanks to some new legislation. Where did all that operating cash and borrowed money go? mostly into acquisitions. They used a staggering $3,354.0 million for acquisitions in the first 9 months of 2025, a slight decrease from $3,528.2 million the previous year. Big ticket items include CentralReach and Subsplash, which added over $2.6 billion in purchase price. This clearly shows their strategy, buy and integrate. On the financing side, they raised $2,000 million from issuing senior notes in August 2025, and another $2,000 million in August 2024. This is how they fund some of those big purchases. They also borrowed more on their credit lines, but paid down some of their older debt. Stockholders' equity also grew, reaching $19,992.8 million by the 30th of September 2025, up from $18,867.6 million at the end of 2024. This increase is fueled by retained earnings, which is the profit they've reinvested back into the business. Speaking of profits, their net earnings for the first 9 months of 2025 were $1,107.9 million, a small increase from $1,087.0 million last year. While the overall profit is up slightly, it is important to remember this is after all the costs, including the amortization of all those acquired intangibles and interest on their new debt. On a per share basis, their diluted earnings per share came in at $10.23 for the first 9 months of 2025. Up from $10.06 in 2024. This suggests that despite issuing more shares through acquisitions and stock compensation, their overall profit growth outpaced the increase in shares. Let's look at the third quarter specifically. Net revenues jumped to $2,017.5 million, a 14.3% increase compared to $1,764.6 million in the same quarter last year. Their application software and network software segments showed particularly strong growth, mainly due to acquisitions. Income from operations for the third quarter was $573.0 million, up from $496.6 million last year. The operating margin, which tells us how much profit they make from their core business before interest and taxes, was 28.4% of net revenues. This is a good, stable margin, indicative of strong operational efficiency. However, there is a growing cost here. Interest expense net increased significantly to $89.7 million for the third quarter, up from $67.7 million last year. This is a direct result of that increased debt load we saw on their balance sheet. More debt means more interest payments, which eat into their profits. They also have an equity investment in a company called Indicor. In the third quarter, they recorded a gain of $12.9 million from this investment, mainly because its fair value increased. This investment is valued using what they call level 3 inputs, which means it involves a lot more judgment and estimation. It's also worth noting they received dividends from this investment, which is a nice bonus, but it is also used to offset cash taxes. Their income tax rate for the third quarter was about 20%. It decreased slightly from last year, partly due to some tax benefits from legal restructuring and the new legislation we mentioned earlier. On the balance sheet, total assets stand at $34,584.4 million. That's a significant leap, primarily driven by the massive increase in goodwill and other intangible assets that came with their recent acquisitions. Their long-term debt has also climbed to $9,154.1 million. This is up considerably from last year, reflecting the funds borrowed to fuel their acquisitive growth strategy. Despite the increased debt, good news for shareholders. Total stockholders' equity has grown to $19,992.8 million. This increase comes from retained earnings, showing that the company is still profitable and reinvesting its earnings back into the business. When we combine debt and equity, their ratio of net debt to total net capital is 31.4%. This means that a little over 31% of their total capital comes from debt. That's a pretty moderate level of leverage, which is generally seen as healthy, especially given their strong operational cash flow. Digging into the details, we see some interesting points. They've approved a new share repurchase program for up to $3,000 million. This means they believe their own stock is a good investment and they plan to buy back their shares, which can be good for existing shareholders by increasing the value of remaining shares. Now, looking at Roper Technologies, it is clear they have a very focused strategy: acquire market-leading software businesses and integrate them. This approach has led to impressive revenue growth and a solid market position. They've successfully grown their revenue organically and through acquisitions, and their core businesses are generating healthy profits. The increase in debt is a direct consequence of this strategy, and while it's growing, their leverage ratios still appear manageable, given their strong cash flow from operations. The biggest risks here are probably the integration of these many acquisitions. Making sure they all work together smoothly and deliver the expected synergies is always a challenge. Also, The increasing interest expense could become a bigger burden if interest rates continue to rise. On the flip side, the opportunity lies in continuing to find and successfully integrate high-value software companies in niche markets, which seems to be their forte. They are betting big on software and technology, and so far that bet is paying off handsomely in terms of revenue. The real test will be how well these acquisitions continue to perform and how they manage their growing debt. They are clearly committed to growth, but maintaining profitability and managing that debt load will be key. Alright, that is our breakdown of Roper Technologies' latest financial report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.